So the first slide is just a 2018 market recap. What's happened this year? So Asian markets are down quite a lot. It's been, things peaked on January 29th, and they've been going down pretty much ever since. So Asian markets, MSCI Asia ex Japan, is down over 20%. And during this time, you can see from the chart on the left-hand side, the US market has actually held up very, very well. And a lot of the things that were leading to this, China in particular selling down was obviously the trade war. And it's been our view for quite a while that the trade war is going to be bad for the US and for China. And so the fact that the US wasn't going anywhere and China was getting absolutely hammered seemed like a bit of an unfair divergence. Now, since, in about the last month, the US has started to come off for a number of reasons, but that's still a really, really big gap between what's happened in the US and what's happened in China. The graph on the right-hand side shows the impact of this fall on valuations. So, you have a lot of very inexpensive Asian markets now. You have Hang Seng China Enterprise Index, which is trading at less than 8 times. That is very inexpensive. Kospi is always cheap, but this is particularly cheap at less than 9 times. And you have the whole market, which is around 12 times versus its long-term average of around 14. So these markets have sold off a lot, and you can see also versus the US, developed markets remain much more expensive, particularly the NASDAQ and S&P 500. So, this chart has been diverging for quite a while, and valuations have been cheap for quite a while. It's been our view that you need a catalyst in order to turn things around. People aren't going to go to bed with China Hang Seng at 8 times P and wake up the next morning and be like, oh, it's cheap, and pile all their money in. You need a catalyst to turn things around. So actually 2 catalysts happened last week, which were positive catalysts. The first was Chairman Powell made some comments about US interest rates, which were saying that the current rate is near neutral. And a lot of people were thinking that there's going to be 4 rate rises next year, and that made a lot of economists pare that down to, as you just heard, to 3 times from Goldman Sachs. Our global macro team is saying 2 times, and Paul Tudor Jones is in the news this morning saying there's not going to be any rate rises. So this is a very strong positive for Asia and emerging markets. We'll get to a slide specifically about that later. So that was one catalyst, and the second catalyst, which was very widely watched, I'm sure you've all heard and read about it, was the G20 meeting. And it was our view going in that there was going to be some sort of de-escalation at that meeting, not a resolution, because these issues are very complicated and you can't just have one dinner and one handshake and sort them out. But we thought there would be at least de-escalation, and that did happen. So we had positioned a little bit going into that G20 meeting, just reducing cash slightly and buying some of particularly the technology stocks, which would benefit from a de-escalation in the trade war. So that trade lasted for all 24 hours because, as many of you know, that's exactly what happened at the G20. And, markets were off to the races on that Monday, and we were like, we can just sit back and watch the market, sail off into Christmas and things will be great. And then the CFO of Huawei, which is one of the largest companies in China and probably the leader internationally in terms of telecommunications technology, was arrested in Vancouver. And this has caused a lot of issues. As I'm sure you can imagine, the day she was arrested was actually the same day that they had the dinner. And so a lot of people are saying, what is going on here? You can't be shaking hands with my good friend President Xi and arresting Chinese people at the same time. So there's a lot of angst going on there. It has created some concern that this 90-day truce that they had at the G20 is not going to result in a resolution. Thus far, and I've been surprised at this, China has not spat the dummy and said, okay, forget about this truce. We cannot negotiate with you if you're holding our citizens, hostage in not hostage, but if you're arresting our citizens in another country. They have continued along the path of negotiation, but it does sort of put a damper on that whole post-G20 recovery story. So with that, I will just move on to the next page. There is some good news here. The good news is that emerging markets are very correlated with US interest rates, and particularly with the US dollar. So you can see that very clearly on the chart on the left-hand side. And like I said before, in terms of the trajectory of US rates, if that starts to be paired off, it's very positive for emerging markets. There are a lot of strategists, and I strongly agree that EM ex China will outperform DM in the next few months, because a lot of markets like they're small markets, Indonesia, Philippines, a lot of the ASEAN markets have been absolutely hammered on this US rate trajectory story, and that seems to be pairing off. So valuations in those markets are very attractive, and the currencies have also been slammed, and that you could see a reversal there with the US dollar. So as many of you who have been around for years would know, I generally don't have much exposure at all to ASEAN. I don't like those economies because we knew that US interest rates were going to rise. They were at 0, so by definition they had to rise. But just recently, we have started investing in some of the ASEAN countries, Philippines and Indonesia, to be specific. Indonesia, we bought a bank called Bank Rakyat. That's been one of the best performers in the portfolio in the last month. So moving on, at the beginning, I mentioned that this has been an 11-month sell down. It's over 20%. So we wanted to do some analysis to say, okay, how does this compare to other corrections in Asia? So we looked at six large corrections in the last few decades, and we noticed that they fall into two buckets: the big corrections and the small corrections. So in the big corrections, you obviously have Asian crisis, tech wreck, and the GFC. And then in the smaller corrections, you have SARS, taper tantrum, and RMB devaluation. So the big ones, these lasted generally 18 months to 2 years, and markets fell 50 to 60%. So those are the biggies. And then the smaller ones, they generally last, 6-ish months, and markets correct around 20%. So you need to ask yourself, this is what we've been asking ourselves, is this a biggie? Is this another GFC? Is it another tech wreck? Or is this sell down just a correction in a longer term structural bull market? And I think that it's the latter. If you look at a lot of the indicators, this certainly from a fundamental perspective, this doesn't look like GFC. Valuations do not suggest this is like a tech wreck. And from a macroeconomic stability perspective, this is nothing like the Asian crisis. So from that perspective, it does appear that it's more a buying opportunity than a time from a long-term view than to run to the hills. That said, I do maintain that we are going to need another positive catalyst to get markets moving the other way. The way things are going with trade in this Huawei situation, that's not enough to make markets just turn around. We're going to need something else positive to happen. The other point about this chart, though, is that after there's a correction, Asian markets rebound very, very strongly. So you can see the average after these corrections is 54% upside in 1 year. So portfolio managers investing in Asia, you need to be nimble, because when things turn around, they turn around really, really fast. And you can't sit around being high cash for months and sort of miss the turnaround. So we'll get to positioning a bit later, but I think one of the takeaways in this market is that you need to be quite nimble. This is just an outlook. What do we see happening next year? The first is what's going to happen in the trade war. The second is U.S. rates and emerging markets, which we've discussed a little bit. The third is what's happening in India, and the last is tech leadership. So in the trade war, some of you who maybe came to our roadshow would know we've been talking about 3 different scenarios. One was tit-for-tat escalation. The second was negotiated outcome, and the third was extreme retaliation. So as I mentioned before, you kind of went through all 3 in about a 48-hour period last week. Right now, we're sort of on a dual track where you have the negotiations continuing between the administrations, but you also have some of this extreme activity about Huawei. What we're watching is whether China responds to that extreme activity with something of their own, whether they arrest Chinese people who are American people who are in China, whether they say, okay, you're going after our tech leader, no more Apple iPhones in China. There's a lot of things that they could do on a company-specific basis, which would be painful for the U.S. Thus far, it hasn't happened, but we're watching that. U.S. interest rates and stress in emerging markets, I think we've covered that. In terms of elections, there is elections coming up in Indonesia, Thailand, and India this year. In Thailand, obviously, they've had a military government for the last 4 and a bit years. We expect that to transition to a civilian government, which would be a positive. Indonesia, our base case is that status quo is maintained with Jokowi as the president. India is probably the most interesting in terms of election cycle. Those of you who have read the news this morning, check Bloomberg's. The governor of the Reserve Bank of India resigned last night, which is unfortunate because there's been some disagreement about central bank independence. So India's probably not going to have a great day today. But our base case remains that Modi will stay in power. Probably BJP will have a minority government, so his execution capabilities will be diminished versus this term. However, as we all know from watching the US elections and Brexit and the Malaysian elections and a lot of things that are going on, you can never be too sure in this environment. So we are keeping our eyes very closely peeled to what's happening politically in India. And then lastly, in terms of leadership by Chinese tech stocks, if you remember in 2017 and the first month of 2018, it was really the Tencents and the Alibabas and the Baidus of the world that were really leading the charge and leading Asian markets up. And since then, the FANG stocks in the US and the BAT stocks in Asia have fallen quite a bit. And so we're asking ourselves, is this the new normal? Have people rotated out of growth into value and this is to stay? Or is this just a blip sort of in the long-term development of these companies? So we're actually relatively still positive on Chinese tech. And by that, I mean the BAT stocks. not the supply chain stocks. We've completely moved out of supply chain because with the trade war and this Huawei issue, it's a very, very risky place to be. But in terms of Tencent and Alibaba and Baidu, we are positive on those. Tencent in particular has a company-specific catalyst coming up. Those of you that follow the stock closely may know that there's been this games approval issue in China, and no new online games have been approved for many, many months. That is expected to resume approvals by the end of 2018 or at the latest by the end of Chinese New Year, early next year. So that's a stock-specific catalyst for Tencent. It remains one of our largest positions. So lastly, I'll just talk briefly about how we're positioned. About 9 months ago, we saw this trade war thing coming and being quite difficult for some of the Asian markets. So we moved the portfolio very strongly towards domestic demand sectors and domestic demand countries. So that's one of the reasons that we've been very overweight India, is because it has nothing to do with the trade war. It just keeps bubbling along. GDP growth 7.5%, regardless of what happens between the US and China. And we've been overweight domestic demand sectors like consumer and financials. Financials is the biggest sector weight right now. That's for two reasons. One, because it's domestic demand. Secondly, because financials are generally low PE stocks. So in this rotation from growth or high PE stocks into low PE, financials do very well because they still meet all our growth criteria, but they are generally trading at 12, 14 times PE instead of 30 times like some of the tech stocks. And then, so that's just sort of overall how we're positioned. In terms of our top 10 holdings, you can see there is a lot of technology and financials. That's primarily our top 10. But we remain quite concentrated with 47% of the portfolio in the top 10 positions. Lastly, I'll just talk a little about EAI as a stock. So as you know, EAI, our fully diluted NTA is around 104 as of the prior week. So the most recent fully diluted NTA will come out later today. And the current stock price, we wrote this yesterday when it was at 99, but it closed at 101. And we do have these options expiry coming up in February. So the exercise price is $1. So we are hoping that the stock price gets well above $1 before then. But in these markets, things are obviously volatile and not a lot of visibility. So we're just asking shareholders to keep a watch on it. And we will send documentation out in early February so everybody knows what to do with their options and where the stock price and the NTA is at that time.